So in this video, I'm going to take a look at margin trading, what it is, and give you an example of why it's a good and a bad thing. Now, margin trading simply means that you are using margin to control larger positions, what is known as leverage. So, for example, if you have 1 to 50 leverage, meaning that you can control 50 times what your margin is, that's your deposit you put up for a position, you get the same gains and, more importantly, for longevity's sake, losses that controlling 50 times your money can occur. And that's what makes margin trading so attractive and dangerous. So, for example, let's say you want to trade the euro-dollar pair and you want to short an entire lot, so that's 1,000 units. Well, you're going to have to come up with 2,000. That is 1/50th of the position. Problem with this is that you need to keep that 1 to 50 ratio going. So as soon as the position moves against you, just one tick, you're in trouble because your margin doesn't cover the necessary position. With that in mind, you don't use your entire account margin anyways. So what happens is, let's say you move 10 ticks in your favor. Well, those 10 ticks, and again, this is a 100,000 position, so 100K. Those 10 ticks equals $100 in this case. So you end up with $2,100. That's a nice return for a relatively small move. But that works in both directions. So your $2,000 could become $1,900 if the leverage is working against you. So you have to keep in mind that's the good and the bad side of it. Now, realistically, these pairs don't move that much if you didn't have leverage. There was a time when you had to have basically $1 million or more to even get involved in the currency markets. So the spreads were really wide. We're talking, instead of 2 pips in the euro, you might be talking, and it would have, of course, been the German mark back then, or the French franc, or whatever. You might be talking, instead of like a few ticks, you might be talking like an entire handle. So, the quote might be something more like this as opposed to what we are used to now. So that's 100 points. That's not uncommon at all back then. So as the spreads tightened, retail traders were offered the ability to trade with this margin. The problem, of course, is in our previous example, well, once you only have 1,900 in your trade that is going against you in your account, you're automatically liquidated. It's a margin call. You do not have the necessary margin, which is the bond, the performance bond you put up, in that case $2,000, to ride this bigger position of 100,000. So as soon as you don't have that, you're done. So that tells you right there not to margin out the entire account. So if you have a $5,000 account, as an example, you could, in theory, open up a massive 250,000 position and play that, but obviously that's going to be very dangerous. But what you might want to do is perhaps dial it back a bit. Maybe only trade something along the lines of $1,000 worth of margin, which allows you to cover 50,000 position. So that's still $5 a pip. That's still pretty healthy. And to be honest with you, this is too large too, but this is just an example. And that gives you $4,000 worth of margin to play with. So the position can go pretty decidedly against you, and you'd still be okay, at least for a while. Now, what you may find is $1,000 is too much. So that's more of a realistic number to have over several pairs. With a $5,000 account, most professionals, honestly, won't trade more than a 35,000 size position. You're talking about 1 to 7. So you're not taking advantage of the 1 to 50 leverage. You have it available to you, but in real terms, and that's how you have to think about it, how are you really levering up your account? Well, that'd be a 1 to 7. If you're trading just one mini lot of 10,000 in currency, say, in this pair, well, that's 1 to 2. And to be honest with you, that's not that uncommon. That not only requires very little to open up, but it also gives you a ton of margin at your disposal if you see other opportunities. Maybe the only opportunity is in euro dollar when you open it up, but then you see something in pound yen. Well, by being dialed down quite a bit, you can take advantage of all of these possibilities. At this point, though, you just simply cannot over lever your positions. That is, without a doubt, one of the most dangerous things you can do. So, just a word of caution on margin trading.